As election season intensifies in the U.S., the IMF has issued a stark warning to the U.S. about its rising debt and fiscal deficits. In its annual report, the IMF highlighted that the U.S.'s debt-to-GDP ratio could reach 140% by 2030 if current trends continue. The IMF's annual report highlighted a major concern. The U.S. fiscal deficit is too large, driving a predicted debt-to-GDP ratio of 140% by 2030. According to the U.S.'s own estimates, the national debt could balloon to $56.9 trillion by 2034. The IMF emphasized that in an era of high interest rates, the U.S. will face increased borrowing costs, potentially compromising fiscal stability. To address these issues, the IMF recommended finding efficiencies in spending and raising taxes on households' earnings less than $400,000 annually. The IMF report also criticized the U.S.'s trade policy, citing growing risks from protectionist measures, recent tariffs on advanced manufacturing goods from China, and threats of universal tariffs on all imports that poses a major threat to both U.S. and global economic growth. Additionally, the IMF pointed out that the U.S. has made insufficient progress in addressing banking issues, particularly those exposed by the 2023 Silicon Valley Bank failure. The IMF urged the U.S. to adopt tougher bank supervision and reduce the pool of uninsured deposits to strengthen financial stability in the country. The IMF report praised the U.S. economy for its recovery, forecasting GDP growth at 2.6% for 2024, slightly revised down from previous estimates, with a dip to 1.9% in 2025. However, the IMF stressed the need for the U.S. to reform entitlement programs and end partisan debt ceiling standoffs to mitigate systemic risks. The IMF also recommended that the U.S. should unwind trade barriers and invest in worker training and infrastructure to strengthen competitiveness. Treasury Secretary Janet Yellen acknowledged the IMF's assessment, emphasizing the importance of addressing these economic challenges to ensure long-term stability.